Morning, everyone, and again, welcome to Mid-Year Review 2024. So my name is 𝗪𝘃, and I'm with the research team at FSMOne, iFAST. And to kickstart today's event, we'll be revisiting a couple of our key points from our outlook that we shared earlier in the beginning of 2024, how things have changed since then, and what to expect in the remainder of this year. So I have quite a number of points to cover, so without further ado, let's get right into it. So the first topic that I want to cover today is on inflation and interest rates. So in this chart over here, you can see that US inflation, it has come down substantially since it peaked around 9% in 2022. And as of May of this year, US CPI is currently at around 3.3%, while core PCE is at 2.6%, which is still well above the Fed's target of 2%. And if you look closely at the chart, you can see that after moderating for much of 2022 and 2023, inflation, it is basically more or less unchanged since the beginning of this year, which indicates that inflationary pressures, they are still lingering. Now, this is not surprising to us, given that the labor market in the US remains relatively tight, adding more than 270,000 jobs in the month of May. There's also a notable disparity between the number of job seekers and jobs available, with the ratio being 1 to 1.3. And of course, tight labor markets, they tend to result in higher wage growth and in most cases, stronger consumer spending, which thus feeds into inflation, which is why we hold the view that inflation is going to stay higher for longer. Now, if we look closely at the various components of the CPI index, we can see that shelter costs, which makes up the majority of the CPI index, around 35%, has been the leading contributor to inflation thus far, as food as well as energy prices, they have moderated throughout the year already. So recently, housing market indicators, they have shown an upward trend thanks to elevated mortgage rates, with both rents and home prices ticking up. So this is partly due to low housing inventory, as people in the US who have locked in their mortgages at extremely low rates, they are of course unwilling to give them up given the high mortgage rates that they are today. So for those of you who don't know, the US mortgage market, it works a bit different from Singapore. So even though Singapore, we have fixed rate mortgages, they are not truly fixed rate. They are fixed for just the first few years. After that, you have to refinance into a board rate or another fixed rate. But in the US, if you lock in a mortgage rate at 3%, for instance, that is the rate that you pay for the entirety of your mortgage, be it 25 years, 30 years, so on and so forth. And considering the lag in CPI shelter data, that could also mean that rising shelter costs, it will be progressively factored into CPI in the coming months, which thus feeds into inflationary trends. So furthermore, supply chain disruptions, such as those caused by the Red Sea shipping crisis, is also adding to inflation, with shipping rates more than doubling since the beginning of the year. Now, while shipping rates at this point in time, they are not as high as pandemic levels, it is moving in that direction, and with global demand robust and tensions brewing in the Middle East, we could see a similar situation, which again keep inflation elevated. Now, a strong US economy, underscored by the resilient housing and labor market, does not support the case for the Fed to ease monetary policy. We reiterate our view that we held since the beginning of 2024, that there will be no Fed rate cuts this year. So over the past few months, there has also been a noticeable shift in interest rate expectations, with the markets initially pricing 6 interest rate cuts at the beginning of the year to just 2 this year. And for the Fed, it also reduced its rate cut forecast at its June policy meeting. Now, the Fed dot plot only suggests that rate cuts, there will be only 1 rate cut this year, which is down from 3, which they have indicated in their March projections. So to position for an environment of higher for longer inflation as well as interest rates, we recommend investors to focus on high-quality companies, such as those with stronger balance sheets, resilient earnings, competitive advantages, as these companies, they should be able to weather this challenging macroeconomic environment easier. And for fixed income, we prefer shorter duration bonds due to their lower sensitivity to interest rates. So for instance, if you have invested in a longer duration bond at the beginning of the year, betting that rates would fall, your returns would be significantly lower compared to someone who has invested in the shorter duration bonds, because bond yields have really risen throughout the year. If you look at the US 10-year Treasury yield, for instance, it has risen from about 4% at the start of this year to around 4.5% today. And aside from these products over here, the fixed income funds. Like Joshua mentioned, we also have our in-house cash solutions, which is iFAST Auto Sweep account. It's currently available in 3 currencies. I think that is also one of the places that you can park your money if you're looking for something short duration, liquid, and easy to use. So more on our fixed income outlook will be shared by my colleagues in the sessions later on. Now moving on to US equities. If you haven't heard, we recently made some significant changes to our outlook for the US, which includes raising our fair PE from 18 times to 22 times, and also upgrading the market from 2.5 stars to 3 stars. So these changes, they reflect our longer-term view of the market, which we believe will continue to excel in the years to come. And over the next few slides, I'll share our reasons why. So the first reason that we have is that the largest and highest quality companies that you see in the world today, they are mainly US companies. So if you look at the chart over here, the table over here, you can see that out of the top 10 companies that are listed by market cap, 8 of them are actually US firms. And among these 8 companies, 6 of them are actually big tech companies. So many of these companies here, they also operate on a global scale, holding dominant positions not only in the US, but also across various international markets. Many of these companies, like I mentioned, they also have strong balance sheets, they are flushed with cash, which enables them to navigate this higher for longer interest rate environment with ease. So if you look across the various sectors that we have in the world, there is a good chance that you'll find one or even more US companies sitting right at the top. So for example, most of the leading semiconductor companies in the world, such as the likes of NVIDIA, Intel, AMD, these are all US companies. Close to 70% of the world's cloud computing market is dominated by just 3 companies: Amazon, Microsoft, and Alphabet. And even in the pharmaceutical industry, 4 out of the top 5 companies ranked by revenue, they are US companies. Now I can go on and on, but I think you get the idea. In short, the best stocks to own today, they are US companies. So another reason that we have turned more positive on the US is because of the rising allocation of tech companies within the S&P 500 index. So take a look at this chart over here. You can see that prior to the dot-com bubble, tech stocks, they accounted for less than 10% of the entire S&P 500 index, while at the time, your largest companies, they were mainly from your consumer, energy, and the industrial sectors. Fast forward to today, tech stocks, they account for a staggering 32% of the entire S&P 500 index. That is a significant increase. But that's not all. If you were to include other companies that are not officially classified as tech within the SGX classification, such as Amazon, which is a consumer discretionary company, and Meta and Alphabet, which are classified as communication services companies, this proportion of tech or tech-adjacent companies actually rises to close to 50%, which again is a significant amount. So the increased representation of tech stocks, it has a profound influence on the valuations and also the earnings of the S&P 500 index. So on this chart over here, you can see that over the years, the average PE ratio of the S&P 500 over various 5-year periods, it has increased from about 14 times back in 2009 to 2014 to around 21 times today. So this is no coincidence, and is most likely driven by investors paying higher multiples for tech stocks given the potential to deliver stronger earnings growth. And delivered they have. So over the past decade, earnings for US tech companies grew at a compound growth rate of 11.2% compared to the broader market, which is around 7%. And going forward, we think that as more of these technology megatrends, they continue to take hold, the tech sector is expected to deliver even stronger earnings growth of as much as 25% year over year, again leading the broader market. So ultimately, as the world moves towards trends such as digitalization and innovation, we believe that the positive outlook for tech companies and their higher weighting within US equity indices will provide the US economy with a long runway of growth and also the basis for multiple expansion, which in other words translates to higher returns for you as an investor. Hence our positive view on US equities. So if you'd like to invest in US equities, you can consider the products listed here in this table. These are mostly our recommended ETFs and funds. Now, before I move on from tech, I'd like to share some updates on the semiconductor sector also, which is a sector that I look at quite closely. So this is also one of the sectors that we are immensely positive on. So if you joined us at the beginning of the year, you would have heard us say that we expect this sector to rebound strongly given the strong recovery in the inventory cycle and also strong demand backed by structural drivers such as AI, for instance. I think this has largely come true because if you look at the chart over here, you can see the industry sales growth, it actually grew by about 15% in the first quarter of this year. And it looks on track to deliver double-digit sales growth over the next few quarters. And this surge, it is mainly driven by the strong demand for high-performance computing chips or those used in AI applications. So for instance, TSMC said in its recent earnings call that it expects that it is incredibly bullish on this AI trend, and it expects AI to be the single largest contributor to its incremental revenue growth over the next few years, and possibly for this sector to account for more than 20% of its revenue by the year 2028. And if you look at the chart on the right, you can see that as the semiconductor industry enters a new upcycle, share prices, they have also done incredibly well. So if you've invested in our recommended ETF, which is the VanEck Semiconductor ETF, your gains will be about 55%. But if you were more daring, you invested just only in NVIDIA, you have returned more than double this year already. Now, besides AI, another important driver of chip demand that is often overlooked by investors is the automotive sector, vehicles, car makers. So these days, cars are becoming increasingly digitalized as well. And with global EV sales set to skyrocket in the coming years as countries, they continue to pursue their environmental goals and transition to a low-carbon economy, we think that opportunities in this space, there are plenty. So while a traditional petrol vehicle will have somewhere between 300 to maybe 1,500 chips inside the car, EV today has nearly twice that amount. And those cars with self-driving capabilities, they will require even more of these chips given the sheer numbers of cameras and sensors that they employ. And according to estimates by Infineon and Tech Insights, the semiconductor cost of a car today, in a petrol vehicle, it is roughly $750. So in a comparable EV, it is roughly double, around $1,300. And by the year 2030, this amount is expected to grow to as much as $2,000, which is a significant opportunity for these chip makers to capitalize on. So overall, I think that despite the wild surge in share prices today, like I've shown you in the previous chart, we think that little has changed in terms of our view for semiconductors. So we continue to hold the view that semiconductors, it will be one of the best performing sectors of this decade, as the world becomes increasingly digitalized and we see more semiconductor applications and also higher silicon content with them. So valuations, they are indeed a little bit expensive relative to recent history, but I think it's helpful for everyone to know that these valuations, they are not unjustified as they are supported by strong earnings growth of these chip makers, including NVIDIA. And so investors who would like to invest in this sector, you can consider our recommended ETF, which is the VanEck Semiconductor ETF. Now moving on, the next point that I would like to touch on is Japan. So similar to what I've shared at the beginning of the year, Japan, it still is one of our favorite markets this year alongside the US. So year to date, the Nikkei 225 index has rallied by around 22%, making it one of the best performing markets in local currency terms. So of course, when you look at things in Sing dollar terms, the returns are less attractive as the yen has been falling against the Sing. Not too good for you as an investor, but good for you as a tourist. But I think nonetheless, the returns are still commendable at about 9% year to date. So that being said, Japan still remains one of our favorite equity markets for several compelling reasons. First, we believe that the return of inflation, it paves the way for better economic outlook for Japan. So Japan, it has been through a period of economic stagnation and deflation that started in the 1990s, otherwise known as the lost decades. Today, inflation has returned, and not only that, it looks to be more sustainable, with core CPI matching or even exceeding the Bank of Japan's 2% target for several consecutive months already. Furthermore, the labor market in Japan remains relatively tight compared to historical standard, which places upward pressure on wages. So in this year's Shunto wage negotiations, unions, they managed to secure pay hikes of as much as 5.2%, which is the highest increase in over 3 decades. Such huge wage increments are expected to boost private consumption, thus supporting modest growth for the economy. So in addition to that, in an inflationary environment, companies should also have the room to raise prices, thereby benefiting their margins as well as their earnings. So this whole thing, it has led the BOJ to grow increasingly confident that Japan has embarked on a virtuous cycle of wages and prices that is capable of sustainably achieving its 2% inflation target. It is also this confidence that has led the Bank of Japan to cut rates for the first time in 17 years, putting an end to the ultra-loose, to raise rates for the first time in 17 years, putting an end to the ultra-loose monetary policy that it has maintained for several decades. The BOJ has also said that it could potentially raise rates again in July, depending on the economic data available at that time. So the return of inflation also has another effect on consumers, and that is to prompt them to seek out riskier investments in order to protect their savings. As you already know, inflation, it eats away the value of our money. So for people in Japan, looking at how inflation is returning and how the Japanese stock market has been performing this year, I think it also provides them with a compelling incentive to start investing, which could be another boost to Japanese equities. So next, corporate reforms within Japan's stock market. It is also currently underway and is expected to unlock greater shareholder returns in the coming years. So Japanese corporations, they are known for their conservative stance and also their large cash reserves that are accumulated across the last decades. They are starting to put this cash to use. So over the past decade, the cash and cash equivalents of companies within the Nikkei 225 index have surged by nearly 200%. And the return of inflation, it presents an ideal opportunity for these companies to optimize their capital utilization. So following pressure from the Tokyo Stock Exchange, an increasing number of Japanese corporations, they have disclosed longer-term plans to improve capital efficiency. And as of May of this year, a substantial 72% of Japanese companies that are listed on the prime section of the TSE, they have responded to these calls. This represents a large jump of about 31%, which was recorded in July of last year. So besides that, Japanese corporations, they are also starting to increase their dividend payouts at a record pace. And slightly over 50% of corporations, they have announced plans to raise dividends in the current fiscal year, which ends in March. And this is a historic high also. Share buybacks, they have also gained prominence, with the total amount of share buybacks announced in the first 3 months of this year already exceeding the total amount of share buybacks that were in the last fiscal year. So last but not least, we think that Japan's efforts to reclaim its lost status as a semiconductor powerhouse can help to reposition the Japanese economy towards a positive growth cycle. Beyond markets like US and Taiwan, Japan, it has emerged as a key beneficiary of this AI trend. Its technological prowess in semiconductors, it presents a competitive edge as global companies, they look to increasingly diversify their manufacturing due to increasing tensions between US and China. So if you look at the table on top, you can see that several global chip companies such as the likes of TSMC, Micron, and even Samsung, they have announced plans to expand their manufacturing footprint in Japan, and that is also partly driven by the huge incentives that the Japanese government has handed out to these companies. So not only that, the Japanese government has established a corporation known as Rapidus, which is a homegrown semiconductor manufacturer that aims to produce 2nm chips by the year 2027. So right now, the standard is 3nm produced by TSMC. So in response to the rapid growth of the AI market, Rapidus has also recently upgraded its revenue target to more than 1 trillion Japanese yen by the year 2030, bringing it forward from its previous target of 2024. So with the semiconductor industry on the cusp of revolutionary change driven by the widespread adoption of AI, we anticipate that the Japanese economy and the equity market, it will stand to gain significantly as it places more attention on this fast-growing sector. And also, complementing the structural factors that I've mentioned earlier is the inexpensive valuations of Japanese equities and also the strong earnings growth, which makes it one of our top equity market picks this year. So those of you who are interested in Japan, again, you can consider the recommended products that we have in the table below. Now, besides Japan, we are also positive on markets like Singapore and South Korea within Asia. We see both economies as beneficiaries of the ongoing semiconductor cycle. So South Korea in particular plays a significant role in the global semiconductor supply chain, especially in the area of memory chips, led by 2 domestic firms, Samsung and SK hynix. Both companies, they delivered a strong set of results in the first quarter of this year as operating profit rose substantially as the chip industry went into a new upcycle. And going forward, we do expect both companies to benefit strongly from the demand for high bandwidth memory chips, which are the primary chips used in AI applications. More broadly, Korea's export growth has also been rising for 9 consecutive months on the back of robust chip sales, which rose by 51% year over year in June to a record high of 13.4 billion in June. So we expect Korea's trade-reliant economy to see better days ahead as the global trade outlook improves. Singapore, on the other hand, is also expected to benefit as it's mainly involved in downstream operations such as assembly, packaging, testing, so on and so forth. Our domestic economy, it may also benefit from the shifting geopolitics between US and China. So known for our political stability, prime geographical location, and also our bilingual population, I think Singapore has emerged as a key bridge between the East and the West. So companies which are increasingly looking to diversify their footprint beyond China may look to Singapore. So last but not least, moving on to China. I think many of you already know that we have taken a negative view on China since November of 2022. Our outlook has not changed. We believe that the recent rally in Chinese equities, it is primarily driven by speculation and also the fear of missing out on supposedly cheap Chinese stocks rather than a substantial improvement in economic fundamentals. So since hitting a year-to-date high in May, Chinese equities, they have fallen by more than 10% already as the economy grapples with intensifying trade tensions and a worsening slump in the property market. If you've been keeping up with the news, you'll know that just a few weeks ago, the US actually announced additional tariffs that target China's key industries, such as EVs, batteries, and solar cells manufacturing. A few weeks later, the European Union quickly followed suit. And overall, this has created a very challenging landscape for Chinese EV manufacturers, which has emerged as a high potential economic growth driver during this global transition towards a low carbon economy. The tariffs, they also reflect simmering tensions between China and the West, which I think will probably escalate as we get closer to the US presidential elections in November. And besides its external troubles, China is also facing a host of domestic issues, such as deflation. Consumer prices, they grew by a measly 0.2% in the month of June, while producer prices fell by 0.8%. So this is an indication that demand in China remains relatively weak. And despite multiple interventions by the government, China's property market still continues to be in free fall, with home prices falling by 3.9% year over year, which is the largest fall since June 2015. So overall, our outlook for China is that we believe China is in a structural decline, and in the absence of any reforms, any quick turnaround is unlikely. So instead of China, if you'd like to remain invested in Asia, do consider the other markets that I've shared earlier: Singapore, South Korea, or even Japan. And with that, ladies and gentlemen, I've come to the end of my sharing today. Before I leave, I'd just like to wish everyone here all the best in your investing journey, and I hope that all of you can make lots of money this year. Thank you.